Welcome to another real estate and mortgage tips and tricks video delivered to you by your real estate professional. Many Canadians find themselves bogged down with a bad credit rating for the wrong reasons: illness, losing a job, or simply not understanding consumer credit. Sometimes bad financial situations happen to good people, and bankruptcy is the only way out. But it's not all doom and gloom. There are a number of strategies for putting your credit back on track and getting approved for a mortgage even after bankruptcy. Going from one financial situation to the next only to be declined again and again can be very frustrating, which is where an experienced mortgage consultant on your side can make all the difference. Here are a few factors to consider. Factor 1. Locating the right lender. Some lenders will not approve a mortgage if a bankruptcy shows up on a credit report. However, so-called non-conforming lenders may consider doing so, provided the borrower can demonstrate that he or she has the income to support the payments and is now a good credit risk. Factor 2. Length of time since bankruptcy discharge. Different lenders have different criteria regarding the length of the time since a bankruptcy after which they will grant a mortgage. Typically 2 years, along with proof of reestablished credit. Some lenders may consider applicants with a more recent bankruptcy. Factor 3. Reasons for bankruptcy. If a bankruptcy was due to factors beyond your control, this is more acceptable to the lender than if the bankruptcy was the result of poor money management and excessive debt, which can affect the terms of an applicant's mortgage approval. Factor 4. Size of down payment. With a past bankruptcy, most lenders will consider a minimum of 10% down payment consisting of your own funds, not borrowed or from a gift. On a case-by-case basis, a down payment of 5% or less may be permitted. Factor 5. The type of property. Some lenders will only lend on houses or row townhouses. Very few will consider apartments or stacked townhouses, which may involve stringent criteria to qualify. Factor 6. Credit report. A credit report is a detailed history of how consistently your financial obligations are met. It provides a picture of your financial health based on past behavior. You can obtain a copy of your credit report from Equifax and TransUnion. Factor 7. Credit score. A credit score is an objective summary that translates personal information from a credit report and other resources into a 3-digit number representing overall credit worthiness. A borrower's credit score may determine the rate of the mortgage. Factor 8. Rate considerations. Most lenders charge a higher interest rate and even some extra fees to those with bankruptcy. A lender may grant a better rate if a certain lending criteria has been met, such as 2 years since bankruptcy discharge, good reestablished credit, a credit score above minimum level, saved down payment, good debt servicing ratio, and a long-term history of job stability. Factor 9. Reestablished credit. A reestablished credit shows the lender that a prospective borrower has new credit and has managed it well since bankruptcy. Typically, reestablished credit should involve a recent record of on-time payments on major bank or credit cards. When rebuilding your credit, you need to be aware that a missed payment at this stage could be mentioned on your credit report for the next 6 years and could be grounds for some lenders to decline a mortgage application. Factor 10. Don't do it alone. As your mortgage professionals, we can coach you on how to improve your credit score over time. While you work on bettering your score, we can advise you on how to get a mortgage despite bruised credit. If you or someone you know has gone through bankruptcy, take heart. There is hope. For free, no-obligation consultation on how to get approved for a mortgage after bankruptcy, call us today.